Hello there, everyone. Dave Keller with Market Misbehavior, and welcome to our latest episode of the Market Misbehavior podcast. Our goal with this podcast is to sit down with top market practitioners, investors, educators, traders, portfolio managers, strategists, authors, educators, anyone that we think has some interesting insights to share, stories to tell, and investment wisdom to impart. Today, I think you're going to get a mix of all three. We have a 1-2 father-son duo powerhouse, John Kosar of Asbury Research, and his son, Jack Kosar, also of Asbury Research. I've been able to sit down with John a number of times over the years since I first met John when he was in the leadership of the Market Technicians Association back in the day. I've enjoyed keeping in touch with John over the years. Used to subscribe to his research in my Fidelity days after leaving and going on to other things in my career. It's always been a pleasure to circle back with John. And anytime I've had an opportunity to interview him about market conditions and what he's seeing, I've always been thankful that I've done so. Jack Kosar has been working with John for a number of years now and has become much more involved in the business of Asbury Research, particularly running and maintaining all of the models that they use. So it was really fun talking to John about some of the general takeaways of his Asbury 6 macro model, thinking about sector leadership using their SEAF model, looking at sector flows, but also interesting to talk to Jack, who actually maintains those models, the benefits of using an asset flow model, what that actually means, how you relate the evidence that the model shares with you versus the more subjective analysis of analyzing prices and trends and technical signals. And so I really appreciated this discussion that went back and forth between market takeaways and also just the process of having a disciplined, consistent approach to analyzing market conditions using the best practices of technical analysis. We'll talk about how his Asbury 6, their Asbury 6 macro model remains bullish, but just in the last week here, I'm recording this on July 31st, just in the last week, 2 of the 6 pieces of the Asbury 6 model have turned bearish. It's not enough to turn the model as a whole bearish, but it is starting to indicate some internal weakness, and we'll talk a little bit about what has caused some of those shifts, some of the things that he would be looking for. And I asked John what was the one thing he would be looking for that would tell him the difference between a tactical market pullback and something more significant. And I think you're going to want to hear his answer because I think it was really well said. So please enjoy this great discussion with John Kosar and Jack Kosar of Asbury Research. So super excited to be welcoming back John Kosar to the show. John is the founder of Asbury Research based in Chicago. And today we are doubling down on our exposure to Kosars. We have John's son, Jack Kosar, who's also part of Asbury Research as well. Gentlemen, welcome to the show. Good to be chatting with you.
It's good to be back, Dave. It's good to see you.
See you, Dave.
Yeah, no, I'm really excited. I mean, obviously, there's so much we can talk about in terms of market dynamics and what all we're seeing. I mean, John, you shared a number of charts that we're going to kind of go through starting in a few moments, but start us out at a high level. I mean, as you reflect on conditions here, we're recording this the last trading day in July. There's been such a resilient uptrend from the April low to where we're at now. We have earnings this week. We have a Fed meeting this week. We have economic data this week. All of that appears to still be pushing markets higher. Do you find yourself, evaluating evidence with confidence at this particular moment? Or does this remind you of other periods where it feels like that really nice period before things start to turn negative? Do you have like a spidey sense, or how are you, what's your mindset given the rally and I guess the consistency of the rally off the April lows?
Yeah, that's a great question. Spidey sense, tingling. I think it feels like we're close to some kind of a top. I'm not saying it has to be a big major top. There's a lot of unresolved stuff, right? We still don't know really where we're going with the tariffs. I think we know where we're going with interest rates as long as Powell stays the chairman. But we have 32% since the April 7th low. So I'm looking at this, and some of the more environmental metrics that I look at are starting to get toppy. But what really keeps me on track is the tactical model, the Asbury 6, which we're going to look at in just a minute. That tells me that's kind of like the daily EKG of the market is kind of how I look at that. It shows every little wiggle, but it lets me know despite all of the circus swirling around us, what does the market think? Is it fearful? Is the breath good? Are people still excited to buy the market? All those little questions that you don't see when you just stare at the S&P 500 all day. And it's, with the exception of a week, it's been 4 or more green since April 23rd. And it's 4 of 6 green right now. So I'm still there.
Yeah, I feel like this market can, and again, I don't disagree with you. I sort of have the sense that we it feels like we're near something. But as much as I have felt that at times, right, the evidence still remains fairly constructive. And we're going to go through your Asbury 6 model. I'm kind of interested to see what is not agreeing with that bullish thesis right about now. But Jack, I'd love to ask you, and thanks for joining on the show. I actually think you were lurking in the background the last time I spoke with John, so I'm super excited to have you and get you on camera to talk a bit. Tell me this. I mean, you've been involved now working with your dad with Asbury Research here for a while, and John's told me how helpful it's been to have you running the models and sort of maintaining these models that track market activity. I found in my experience, a lot of sort of novice investors, and certainly people getting started with technical analysis, have a very unstructured, arguably very haphazard approach. They're just kind of looking at something and thinking something's good, and then they make a trade. And your work, what you guys do, strikes me as very disciplined and very consistent. I think the use of models, how you use them, probably is a part of that. Can you talk about the types of models you guys run, what your work is in actually, updating them, and how that sort of adds to the process of evaluating market conditions for you guys?
Yeah, absolutely. A lot of our models are indicator based, and we do that for a couple of different reasons. I think the one is, you watch the market news every day, and someone always is screaming about something, and it can get you excited. It whips up that energy. They want you to be glued to that screen, and they kind of build off your fear and your emotions. And that kind of drives us to indicators. But the other issue is some people fall in love with indicators, especially if you're kind of new to investing. You find one indicator and you swear after looking at the chart that it's a world beater. You know for a fact it's going to be there. And statistically, it could be great 80% of the time, but that 20% that it's not, it can rip your face off. So what we like to do is, we build these models so that we can avoid that noise of people screaming on TV, people saying that it's the end of the world or that this is the greatest bull market they've ever seen. We can really dive into those numbers and have a calm, rational view. It also allows, like you said earlier, there's a lot of things going on, economic numbers, things going on in Washington, geopolitical, and that's kind of a lot to keep in your head at one time. So we build these models, we orchestrate these indicators that we understand kind of a broad view of the market, and we just follow them. It keeps us, my dad always says, we sleep better at night when we follow the numbers and we follow the data. So we build these models so at the end of the day, we could sleep better at night and we have an idea what's going on in the market despite the noise.
I feel like there's been a lot of lost sleep for on the investment side here in 2025. That's really well said, Jack. And, it's funny. I was taught to try to get away from emotion-based decisions, right, and get more toward evidence-based decisions. And John, in working with you over the years and having a chance to catch up with you regularly, I always appreciated how it is a very evidence-based process, right? It's not what we think should happen, which a former therapist of mine called that shoulding all over yourself. It's not about what should happen or what might happen. It's like, let's look at the evidence and what the markets are telling us. And I think with some of the models, so hopefully we can start going through here. I think people are going to pick up on that very, very quickly. So, John, you'd mentioned the Asbury 6 model earlier, and this is a model that you and I have reviewed, when we've spoken before, combined some of the macro themes that you're seeing and really focuses on the weight of the evidence. As you mentioned, 2 of the 6 sort of components to that model currently negative, and just in the last just this week, it looks like have turned negative. Can you just talk to us about the state of the Asbury 6 model, what it tells you about conditions now, and what sort of warning signs you might be looking for as we go into August, sort of seasonally weaker part of the year, right?
Sure, yeah, it is August and September. This is kind of like the Moneyball approach to investing, right? So we want to build a lineup of players. These are our players. There's only 6 here, based on statistically what they bring to the table, right? And you might have somebody if you recall the movie, there was an overweight catcher that nobody wanted, but he got on base like 70% of some crazy number. So we try to find 6 indicators that are different from each other that will keep us from biting on a bad signal, because the other ones will pick it up during those periods where it's not working. No indicator works all the time. So 6 indicators, we need 4 or more in order to be positive. And you can see those 3 of those 4 turned back to positive on June the 23rd. We've got the rate of change in the S&P 500 that just flipped on July the 28th, and market breadth flipped as of the close yesterday. So what does that tell us? It tells us the market's losing upward momentum. It's picked up some momentum today. We're up 26 right now as I look at my screen. And market breadth means we need better broad participation. It looks at market breadth and the NYSE. So the thing you can't see here is there's another 2, and I can't remember which ones they were, but there's another 2 that I would call on the bubble, which means either the market needs to get up and go here between now and early next week, or the metric itself, the model itself, is going to turn to negative by turning 4 or more red. So this tells me pivot point, the market needs to get off the dime here. Now, it's had a pretty good morning here. We're up 26. But if this was to fail, if the jobs number was disappointing tomorrow, this could turn on its head by early next week.
Yeah, I'm not surprised now. I mean, thinking about the different components here, volatility has remained fairly low. The volume's been kind of okay. I guess it depends on how you measure it. We're going to look at volume in a little bit together here. But definitely there's been this sense that the pace of the advance has started to slow down a bit.
Yeah.
And while the S&P and the NASDAQ still kind of making new highs in July, there's a lot of divergences that you're seeing with momentum indicators, with things like the NYSE, with small caps, right? Obviously not doing particularly well. And then the breadth has really started to rotate. We've seen the McClellan oscillator below 0 for most of the month of July, which speaks to some short-term weakness. But I compliments on how you do this and do it consistently. I think probably the consistency of looking at a model like this probably helps as much as anything. Jack, if we could go and look at the SEAF model, this is something that John and I've looked at a number of times. It's basically sector rotation models. I would think about it, but looking at the different S&P sector spider ETFs, this has been an area, of hot debate, right? Because you have certain sectors that have done remarkably well, like technology. And the question is there some sort of leadership rotation that starts to occur? What is the model telling you now about leadership and maybe potential for change in that?
Yeah, I think overall, kind of taking a step back, I've been looking at the asset flows for the 11 sector spiders, kind of going back the last 50 days or so. And I track on a day-to-day basis how much that movement is. And in general, over a 10-day span, you'll have multiple 1% or greater moves up or 1% greater moves down.
On a relative basis, correct?
On a relative basis, yeah. Over the last 25 days, we have not had a single day where assets have increased by 1% or decreased by 1%, which kind of tells me apprehension, right? You were talking about we're a little bit slowing. Well, we're not seeing a lot of that asset movement. That's similar to sector rotation right now. In general, when we know that SEAF is kind of, call it ripping, but it's really found leadership, the scores on the right-hand side are relatively low. So we would expect to see a couple of 3s, 4s, 5s, and that's really conviction in the market in terms of who the leader is. As you can see here, we have 10s, 12s. So things are kind of backing off, which means we haven't defined a real leader. Now, the last 10 or 12 weeks, technology was really leading, but has since fallen off. So we haven't found a new leader yet. And it's too early to say if technology is not going to take that next leg higher for us. But as of right now, we are seeing a little bit of weakness in technology, and SEAF is telling us that we don't have a true leader in the market.
Right. And what this column here, that's the percent through the end of July, 26%. What number is that referring to that for technology?
It's the percentage of if you treat the 11 sector spiders as a pie, that is the percentage of the pie that that sector occupies.
And it deviates slightly from the actual cash.
Right.
But generally speaking, it's pretty close through most of them.
Yeah, that right there jumps out at me, right? Something that is sort of the lion's share of the benchmark started to show some negativity in terms of something to be interested in. It's really helpful, Jack, to be honest with you. I really appreciate how you laid that out. And just looking at how what it strikes me is the benefit of using this consistently, because only then do you realize what you just mentioned, which is, all right, these numbers are starting to be a little higher than normal or lower than normal, I guess, and suggesting, maybe a bit of a rotation here. Let's talk a little bit about drawdowns, because John, in your work, you often refer to drawdowns, and I know, I feel like the shorter your runway is as an investor, the more drawdowns can be a real issue. What is this chart showing, and what's the takeaway for investors here?
Well, the takeaway is the deeper the correction, it's not 50-50. If you draw down 20%, you don't need 20% to get back. You need 25 to get back. Or if 30 is a good one for us to think about, because the COVID collapse was 34%. So at 30%, you need to make 43% in order to get back to where you were at the peak. So when I talk to clients, I explain it to them in a football metaphor. When you're in the first half, you could throw the ball up in the air. You can try some Hail Mary passes. You can handle the ball behind the line of scrimmage, do some trick plays, and you're okay because you're in the first half. You got time. When we're in our 60s, and I'm in my 60s, you're in the fourth quarter of your investment career. So typically, if you've been investing all your life, you have a lead and you're in the fourth quarter. So what do? You put the ball into your big fullback's hands. You try to take as much as the other team will give you without making a huge mistake that's going to change all that work that you did in the first three quarters. And this is the poster boy for that thought.
Oh, I love that. I love the football analogy. Thanks for a summer football analogy. I'll take it. But you're right. You need to be thinking about running the ball, the prevent defense, sort of those things that allow you to, to sort of keep things more stable, low volatility football, low volatility investing. But you're right. People tend to think of those as the same, right? I lose 50%. I need to gain 50% to make it back. And I find people struggle with that even with daily percentage returns, right? You'll see a stock that's down 10% and then you see it up 5%. And you're like, oh, great. We've made it. And it's like, well, actually, you need to gain a lot more just to get back to where we started on day one. So I really love that illustration on there. So what if we could follow this just a moment further, give us an example of part of your approach that attempts to minimize drawdowns, because I think that's the challenge. We want to, as investors, we want to experience all of the upside and none of the downside, essentially, right? So how do we try to balance those potential returns with the risk of potential drawdowns? What in your toolkit kind of helps you navigate that?
Well, the trick, right, nirvana is to outperform the market with less of a drawdown. It's very, very difficult to do. You can use metrics like Sharpe ratios and Sortino ratios to try to tell you how well you're doing on that front. Like this year, our CPM model, which is our first model, it's risk on and risk off. It's either in SPY or it's in a short-term T-bill type ETF like BIL. It's beaten the market by 2% so far this year. The max drawdown in the S&P was 18.9%. In the CPM model, it was 9.3. So that's one of those things where you get the nirvana. Now, it's hard to hold on to it as the markets move and things change, but that's what we're shooting for, is if we can be market performers or a little bit better than the market, but have your drawdowns 40% less than the market. That's, as older investors, that's what you want, because you're kind of having your cake and eating it too. You're still able to outperform. You're in the market. I think the market's been 12.5% on average going back 5 to 7 years. So if you can get that and you can knock your max drawdown in half, that's a really good way to play in the fourth quarter.
Oh, I love it. Greg Morris, who's a longtime mentor of mine, I remember talking with him about drawdowns years ago, and his comment was, as active managers, your goal, and really as we should think about our own portfolios, right? We always want to outperform. We always want to do better than a passive benchmark. It's pretty hard to do that in raging bull markets when it feels like everything's going up. That's very challenging. But just the simple act of being out of the market or being in something defensive when conditions start to rotate, that's where you really can start to generate some outperformance over longer periods of time. I think that's really well said, John, for sure. All right, let's get back to a couple more charts here. And another one is looking at the stock to bond ratio, right? And the relative performance of stocks versus bonds. Talk us through this one.
Sure. This is just a tool that we use to let us know what the general health of the market is. So we've got SPX up top. That's the outright chart. Down in the bottom, we've got the relative performance of SPY, and we use AG, which is aggregate bond index. And we look at those on a relative basis. You can see from February 21st to April 23rd, which is the red highlights on the lower left, we had SPY underperforming AG. And we use a 21-day basis because 21 days is a business month, and that's Asbury's tactical time period. So we're really consistent with, we know what our time periods are, and we use the same time periods. I think a lot of people make the mistake of they use a 21-day for this, a 37-day for that, a 42 for that, and there's no consistency through your analysis. So you should know what your time period is. This is how we move in and out of the time period that we're trying to catch. And for us, it's 63 days or greater. So monthly, quarterly. But you can see on April 24th, stocks started to outperform bonds. SPY started to outperform AG, came down into June 20th and kind of kissed the moving average. It was a nice little near-term low for the S&P 500 if you follow the green line upward. Now we're right back down there again. We're back and testing that line. So what does that tell me? That tells me that this is a tactical inflection point when you're as viewed by looking at the relationship between stocks and bonds and seeing the A6 at 4 and 2, it kind of confirms that. There's two different metrics that are telling me that if we're going to make another leg higher here, it should start from here, or we could have some problems heading into August.
Yeah. So tell me this, because and this is a question I've gotten a lot recently, John, is, I would argue that a tactical pullback that ends up being a really good buying opportunity, kind of like what we saw in June, versus the beginning of a very negative period. A lot of times the very beginning looks very similar, right? Because we kind of pull back to one of those moving averages, and then we either find support or we don't. Is it as simple as that in terms of how you differentiate, or how do you, I guess, validate, this isn't just a tactical pullback, we need to get more defensive? Does it go back to things like the Asbury 6 model, which would rotate more significantly? What would sort of give you conviction, like, okay, not a tactical buying opportunity, this is more of a good time to get defensive?
Great question. And in our little Moneyball lineup, the most twitchy of the Asbury 6 is the VIX.
Right.
So the thing is now, all right, so we're at this tactical decision point. Is the market happy about it, or is it nervous? And if it's nervous, you're going to see a spike in the VIX. And that's often the kind of the fast twitch part of the Asbury 6. If that starts to get elevated, if that turns on our Asbury 6, stays red for 3 or 4 days, you know how the VIX works. As long as the VIX is elevated, the market's nervous, and it's usually really difficult to hold gains. So that would be the next thing to watch.
Oh, that's really well said. And that's one of those things. I mean, there's so many reasons I feel like we could come up with between the three of us as to why the markets could go lower. But something like where the VIX remaining sort of in the mid-teens, the evidence is telling us we're not seeing a lot of anxiety just yet. I think that's a really great point, John, of something to look for here. All right, this is the cumulative volume index for the New York Stock Exchange. Talk to us about volume and how this has maybe been rotating.
Sure. This is another way that we judge the how much volume measures urgency to buy. So you can see it's the same chart, but it's a different way of measuring what the market's feeling. So on April the 23rd, this is a cumulative volume index, which is less jumpy. It's less, frenetic than trying to make heads or tails out of daily volume, which looks like a man having a heart attack to me. It's really hard to read. This smooths things out a little bit. You can see as of April 23rd, started to expand on a 21-day basis. On May 23rd, trend was tested. S&P held. That was a minor low in the S&P up top, the S&P 500. And we started another leg up. We did the same thing on June the 23rd. And now we're right back there again. You can see. So another tool telling me the same answer. We're at a tactical inflection point. So now if you're a manager, if you're managing money, if you're managing your own portfolio, what you would want to do is pull a chart that you're trading, or the S&P or whatever it might be, or the Qs, and try to find a tactical support level that you could marry to these three charts. In other words, what level is the most important chart that I can see that I can kind of attach to what I'm seeing in these kind of secondary indicators? And that might be a place that you can use to limit your risk in the event that things turn the other way.
Oh, I love it. I love it. All right. Final chart I want to go through with you is talking about leadership. Talk to us about the Magnificent Seven. We've got 4 of the Mag 7 names reporting earnings. We had, we're recording this on July 31st before Amazon and Apple are reporting. We just had Microsoft and Meta with pretty solid reports on Wednesday. Talk to us about this mega cap growth story. Is this still a story that dominates the market perspective in your opinion?
Well, I put it in there because it's pretty topical, obviously, because of what just happened yesterday. We had super numbers from Meta and also from Microsoft. So I wanted to see what that chart looked like. So you can see we're testing the all-time high there up in the upper part of the chart, the upper panel of the chart. Obviously, it's a resistance level, right? So either we're going to make new highs here and probably attract some new buyers, or maybe you might, if this starts to soften up, you might get some people that have been owning this since May and June and they want to ring the cash register, take a little profit. So another inflection point. If you look at the bottom, that's MAGs versus SPY. So that's the leadership that we've been getting from MAGs. On April the 24th, that trend turned towards outperformance, MAGs over SPY. We tested that trend. Note how that trend flattened out after we got through mid-May. We're still outperforming, but it kind of geared down a couple of gears, right? It's not going as fast as it was before, and we're sitting right on that trend line, 21-day moving average. It's a moving trend line. If we roll through that 21-day moving average, that means collectively for the Mag 7, we're losing our leadership. And that would be another kind of chip on the scale towards whatever you've got a profit in. Start having a look at how you make sure that you keep most of it.
I feel like so many of these charts feel very actionable right now. They're sort of right at that decision point as to whether it's a tactical pullback and then just the next big move higher, or the beginning of something more painful. We've gone through all these charts, John. We haven't talked a ton about seasonality, although earlier, we sort of discussed how August and then September, of course, 2 of the weakest months. How does that sort of traditional seasonal pattern fit into some of this, the other work that we've talked about? Just really more the evidence, the information the market's providing back to us. What about that normal cyclical pattern to the seasons in the markets? How does that fit in?
I was smiling because you and I, maybe 6 months ago, a year ago, we did an interview and we were talking about seasonality. I look at seasonality as kind of like the wind. It's a component in what the market does, but it's not the main thing. So in other words, if the market is going down or the market's starting to weaken, that seasonality is going to help to accelerate that. Or maybe if the market's strong, right, and it rips out of here and we go straight up until, Halloween, that seasonal will act as a little wind in the face. It may slow that down. So I look at it as kind of a tertiary indicator for me. And it's either something that will accelerate what's already there, or it may impede what's already there, to a certain degree, but I don't look at it as being primary, but more as either an accelerator or a dampener for whatever that trend might be.
John, I can't tell you, as a technical analyst based in Chicago, thank you so much for using a wind analogy. That's very appropriate. I appreciate it. And to remind people, when we last spoke, you shared first time I'd heard the analogy of like riding your bike, right? It's like you're riding your bike into the wind versus it's a tailwind, right? It's sort of providing it. And I've 100% just experienced that in the last couple of weeks of the difference. And so keeping that in mind, that it's sort of headwinds and tailwinds as opposed to absolutes, I think is brilliant. All right, to wrap up here, Jack, you have had the rare opportunity. I always ask people some form of the question of like, what would you tell a younger you? What sort of advice do you have for new investors? You've had an opportunity that very few people do, which is to, be mentored by a legendary technical analyst in your family. But tell me this, give me an example of something that you have learned in your experiences working with John, working with the clients of Asbury, that you feel others just getting started could really benefit from? What's a takeaway that stands out from your experience?
Yeah, I think, as a younger analyst, my intuition is always to go and try to forecast things. We looked at all these lovely indicators today, and we can see maybe some writing on the wall, and the jump is to go, okay, well, we're at a top, right? And really learning to pull the reins back, letting the data tell you what's going on, letting the indicators make their move ahead of time, and not try to be such a forecaster. So I think, telling my younger self, or telling other guys that are in their 30s that are, trying to figure this out, is the forecast sounds great on TV, but at the end of the day, if you're trying to take care of your clients, you stick to the data, you stay humble with it, and you just follow what those indicators are teaching you, and you won't get over your skis.
That was like a little mini masterclass in investment wisdom, Jack. I like that. You mentioned staying humble. 100% agreed, and I would wholeheartedly agree with your assessment that early on we feel like the goal should be to predict the future, and I feel like we probably do younger analysts a disservice by giving them that impression. At the end of the day, what I think we've all come to realize at some point is that it's not about predicting the future. It's just about understanding the trends and having a good awareness of what's happening. I feel like that's where people get into so much trouble. John, to finish off on your side, I just interviewed Adam Koch on the podcast just a couple of weeks ago at Libertas Wealth Management in the Columbus, Ohio area. I know you guys have a partnership that you've worked out. Can you talk about what you're doing with Adam and the team at Libertas, how that links up to what we talked about here with Asbury Research?
Yeah, what Adam and I are doing together is we started to manage money, Jack and I, a couple of years ago. And Adam's firm is helping us with the executions part of it. Adam's team has been doing this for 20 years. They're excellent. Adam's a really conscientious guy. He's a Midwest guy like me. We look at the business, we look at how we take care of clients the same. And so Adam has, I've been doing this for a long time. And it was a lot easier for me to find a guy like Adam that's got a top-notch operation that's up and running, and they can take care of all of our onboarding of clients for us and all the executions. And Jack and I are providing the models. We're, providing the ideas. And there's different facets of our business where we kind of one hand washes the other. And we've made this really nice little partnership where we can cover a lot more territory together than we can separately.
No, I appreciate you updating all of us, and congrats on that. I wish you guys much success, of course, but good to know that that investors can get insights on the research side from Asbury Research, and also some money management capabilities as well. Where can we point people if they want more information on what you guys are doing? AsburyResearch.com would be my guess.
That's the best one. But if you want to see more stuff from us, we've got a YouTube channel, and it's growing. It's growing very well. It was Jack's idea, right? I'm the dinosaur. And he's like, well, Dad, I think we should do more video. And he was right. So we make a lot of videos. kind of made to educate and try to promote our business, let people know what we're doing and how we do it. I think we have a pretty unique approach. When I started doing this, I was a classical technician, and I've really kind of ventured off into my own indicators and my own ways of putting various models together. So it's been a fun evolution, and the YouTube allows us to show people what we do.
Well, we'll put links to your website and to the YouTube channel in the description of the video for sure. John, you and I met years ago through the Market Technicians Association. I'm so thankful that we did, and it's been a real pleasure to keep in touch with you and follow your work for a while. Awesome to see Jack on board, part of the team as well. And thanks for what you guys are doing to keep investors informed and aware. Thanks for coming on the show today, and we'll have to do it again, all right?
Anytime. It was great to see you, Dave. Thanks, Dave.
So I hope you enjoyed that conversation. John and I are kindred spirits for sure. I've always appreciated his technical approach. I've followed his work for many years, and I appreciate the simplicity with which he's able to take a bunch of really good, rigorous technical work, but boil it down to key takeaways that we should be thinking about. And I love his comments about Adam Koch and John and his son being Midwesterners. That's probably why myself, as a Cleveland native, find an easy way to connect with them, because we're all sort of from the same part of the country. But I really loved John's take on the overall market conditions here. I would tend to agree in terms of that tactical pullback and signs of potential weakness versus the things that would tell you it's more significant. And I think now is the time to be thinking about risk and thinking about potential downside and how you defend yourself and defend your portfolio in those situations. Really glad that Jack Kosar was able to join us as well, though, and I really appreciated Jack's comments about models, using models as part of your investment process, the benefits that you get from consistently reviewing market conditions through a model, which allows you to kind of timestamp and quantify what you're seeing in terms of gathering evidence. I mean, that mentality is what I guess encouraged me, or what compelled me to make my own market trend model years ago, which I still refer to every week with my Market Misbehavior Premium members. And that's why that consistency of having a model running in the background that you can always refer to is really valuable. So I hope in your own investment process, if you're a self-directed investor, that you take this interview as encouragement to develop your own model. If you're more of a passive investor, if you're someone who is looking for help navigating these markets, I hope that you think about some of the things John said. You partner with someone like Asbury Research that does a lot of that work behind the scenes and can share with you some of the key insights and takeaways. By the way, if some of the charts and tools and techniques we talked about seem interesting to you and you want to learn more, my goal with Market Misbehavior is to empower investors to make better decisions by understanding behavioral biases and by using technical analysis as a practical set of tools to understand the markets around you. Our Market Misbehavior Premium memberships are designed to help a small number of motivated investors to upgrade their own decision-making and better understand behavioral and technical investing techniques. 3 great benefits to the premium membership. First off, you'll have access to all of our members-only reports, like our weekly flight plan, which is our main report only for premium members, where we talk about key levels, patterns, and signals we're looking for in the week to come. Also, our monthly chart review, which we're just preparing to do tomorrow, where we apply our proprietary market trend model to a series of ETFs and asset classes. Second great benefit, all of our virtual courses: Flight School, Behavioral Investing, Market Misbehavior on Demand, Behavioral Finance for Advisors, and a bunch of other courses that are on my list to create that I haven't quite gotten to, but I will someday. You will have access to all of those current courses and anything that I create as time goes on. You'll have access to all of them through our learning platform. Finally, you will have full and immediate access to our members-only community. This is where a group of like-minded investors can navigate the markets with support of each other and support from me, sharing insights along the way, highlighting compelling investment ideas, and focusing on opportunities to the upside and managing risk potentially on the downside. For more information on our premium memberships, go to marketmisbehavior.com/premium. That has all the information on our premium memberships. And don't forget to use the code podcast when you check out for 30% off your first 12 months on any plan. I always tell people, as much as we feel the need for support and coaching in bear markets, because things get very tough, I would encourage you to think about it during bull markets, because this is when you can get away with a lot of bad habits. There are things that probably aren't hurting you, but the moment the market starts turning lower, that's when bad habits really start to cause some pain for your portfolio. So take the time now to upgrade your decision making, upgrade your risk management, so that you're better prepared for that next major rotation lower. Marketmisbehavior.com/premium. And don't forget to use the code podcast when you check out. That'll do it for today. Thanks so much again to John and Jack Kosar joining me from Chicago. If you have suggestions on other guests that would be great to talk about behavioral investing, talk about technical analysis, market outlooks, and market insight, books that have been written that you think would be cool to hear from the author, I'm open to any of those great conversations, and I would look forward to reaching out to people on your behalf. So let me know through the comments section wherever you're listening to the podcast if you have suggestions for future guests on the Market Misbehavior podcast. For now, I will say thank you so much for listening. I'm Dave Keller with Market Misbehavior, reminding you it's always a good time to own good charts.